This is the part of the show where we focus on the performance of a specific fund, and this week we're focusing on the Prudential Equity Fund. And Cobie, you've got the details. Formation date, August 1999.
Yeah, I mean, again, let's just quickly put into context with the rest of the show. Prudential, we would see here in South Africa as a dedicated asset manager. They're a boutique business in South Africa. They might be part of the bigger Prudential group globally. But this is a business which really runs as one of their satellite businesses in the emerging market and kind of dedicated on, as far as asset management is concerned in South Africa. The managers there, Gary Coon and Chris Wood. The formation date, as Eleni has indicated, is August 1999. The benchmark there, General Equity Unit Trust Mean. I know Roland will have some things to say about that. It's not necessarily the shareholder weighted index or the ALSI, even though I utilize that from an analysis perspective a little bit later. Total expense ratio there, 2.48%. Just looking at returns, if you look at your screen, that's up to the end of December 2011. Over 12 months there, you see some decent returns, 5.1 versus the shareholder weighted index of 4.3. I'm using that as a proxy here as far as the benchmark is concerned, because I just want to look at a market-related benchmark. 24 months, 11.8 versus the SWIX of 12.3, and a long-term track record there of 9.9 versus 8.6. That's for the Prudential Equity Fund. We would call this manager a classic value-based manager. They manage to take valuation strongly into consideration. Price-to-earnings ratios, dividend yields, and all those things become very important before they start dedicating money to a specific idea. Let's just look at returns. Again, the blue kind of shaded areas will indicate the fund's relative return to the benchmark. And the benchmark I'm using here, again, is a rolling 12-month SWIX index. It's not the benchmark for the fund. It's just a market-related benchmark I'm utilizing. And that you can see on a rolling 12-month basis kind of running through time there. You can see that there. So there's some outperformance, some decent outperformance in 2009. And you'll know that on the back end of 2008, 2009 was actually a brilliant year for equities. And you can see the returns there being and showing those kind of returns because the equities are coming from such a low base. Some battling there against the benchmark or against the SWIX in 2010. And that's predominantly because you just had a market that was kind of going flat and you've seen a reversion and P's were quite high. And then you see some outperformance relative to the benchmark during 2011, and some of it obviously being created. Maybe it's the volatility there that created some of those returns. Yeah. All round, pretty good.
Okay, so Roland, why were you not happy, or are you happy with the General Equity Unit Trust being the benchmark?
Well, I think you've got to look at the risk profile of the average general equity fund manager, and then you kind of compare that to the manager that you're looking at, in this case Prudential. And if that risk profile is very different, then that is not a like-for-like comparison. So if they are consistently more value than the average, then they should be compared to a value index probably, or the market or something, but not necessarily what the average is. So
you're not happy with this benchmark?
Well, I don't think it reflects necessarily if the manager's got skill or not, if we use that benchmark. There are better ways to identify that.
So do you think this manager has skill?
Well, one of the things that I have noticed by looking at the different, we look at the drivers of performance. So I look at the position that the manager has taken relative to industrials, financial resources, and I think it sort of also talks to the graph that Cobie showed earlier on, is that the manager was in the past very much a focused value manager, and the way we see that is they have what we call a low beta. In other words, when the market goes up 10%, they don't go up as much, but when the market falls, they also don't fall as much. So they're a conservative kind of manager, and what we've seen in the last year or two is that they've basically closed all those bets down. So they're not as the beta's basically gone to 1. So whatever the market now does is what they do, and that's why the relative performance is sort of flattened out a bit. So I think generally fund managers do this. When there's a crisis, when you have a tough year like 2011, you see people starting to get closer to the benchmark because they don't want to stick out. Maybe that's what's happening here. But I do know these managers, and they are very experienced, and they are deep value managers. I'd just like to see a bit more focus, a bit more bet taking.
Well, I mean, looking at the sector allocation, you've got a big shift towards the industrial sector, 40.2%, resources 29%, South African financials at 18%, international equity, interestingly, around 7% or so, and then you've also got some South African local currency and then international cash as well. Are you happy with that mix? Because the industrial sector right now is actually one of the most expensive in South Africa, but outperforming the rest of the sectors.
Yeah, remember this is an active manager. So, I mean, a lot of what they'd be doing is they'd be looking at the opportunities within the industrial set, and some of the more heavily weighted stocks within the industrial sector they might be forfeiting in order to buy some of the more smaller companies that might be sitting with better valuations. So you're seeing a very large kind of mindset as far as that is concerned in this fund. The important thing for me is if you look on a 5-year basis, you've seen some outperformance, which means from an active perspective, they've actually added incremental value over and above what you could have done by just being passive. And that's what you want for an active manager. And that's
But in the last year or two, we haven't seen that. So they've sort of closed down that focus.
Yeah, and I mean, I think that's the other important thing is that from if I look at Prudential, and this again is my opinion, is that when you sit in a market that looks like we have at the moment, and there's not massive outliers as far, from a valuation perspective, they start looking and converging on the benchmark until such a point when actually, there are opportunities, and then they'll start taking those opportunities. That's how you mitigate your risk relative to the industry.
Roland, you said you'd like to see some more bet taking or risk taking, or making it a more focused decision. What would you change?
Well, the one thing that I have noticed, which is one of the few things where there is a bit of a focus, is that their beta to the resource sector is higher than the market. So they seem to be taking a view on resources. This is quite a short-term effect that's only been evident in the last few months. So maybe that is where, or at least that's what's driving their performance or their portfolio more than the market is. So if resources are a good bet, and I do think resources are relatively cheap at the moment, so maybe that's where their performance will come from. But that's literally all I'm seeing.
What about a total expense ratio, 2.5%?
That is quite high.
Yeah.
I don't know if that includes a performance-based fee that might be embedded in that, but that is higher than the average, yes.
Yeah, I mean that's what happens in a lot of boutique houses is that guys charge money for what they do.
Do you like this fund?
Yeah, absolutely. I like Prudential as a house. I think they're good asset managers, and I think they're dedicated, and I think they run a stable team and have done so for many years in South Africa, which often is a problem in boutique houses. Is to run stability with investment professionals, and they've done it over a long period of time. And they also have a skill base that they can draw from overseas, which is quite nice. So
global research.
Yes, global research is always a fantastic thing to have.
Right, so let's wrap this up. Cobie, last thoughts from you?
Prudential, I think, is good. I like the fund. I think it's a good fund. If you're going to be choosing a general equity manager and somebody to manage equities for you, you could be doing worse than choosing Prudential.
I think what worries me a bit is that we might be moving out of a value cycle to a growth cycle going forward, especially with inflation and earnings growth looking quite bullish. So that would mean that I would probably prefer a growth manager going forward than a value manager, which wouldn't be this fund.
Shifting?
Which wouldn't be this fund, which would be a growth fund somewhere, yes.
Fantastic, gentlemen. We have to leave it there. Do you agree with that, Cobie?
Well, I mean, that's a debate in itself. Maybe, Roland, what we need to do is we need to do a growth versus value show again. I know we did one late last year.
I think that's a good idea.
So that we can take the boxing gloves out and we can have a good show.
We should get 2 fiery guests to join us. Thank you so very much, gentlemen. We have to leave it there.